Welcome back. Lots happening in terms of corporate movements. Samvardhan Motherson has made a big acquisition, picking up 100% stake in Germany-based SaaS Auto System Technik for an enterprise value of 4,800 crores. The company provides cockpit module assemblies for the auto industry. To discuss this, we are joined by the chairman, Vivek Chand Sehgal, and the CFO, Kunal Malani. Gentlemen, morning to both of you, and thanks for joining in. Mr. Sehgal, let me start with you first. Congratulations on this acquisition, a fairly large one compared to your own size. So tell us a little bit about the rationale and what will it add in terms of both synergies for Samvardhan, as well as how much the content per vehicle can go up by, considering this company has a large presence globally, a large presence in the fast-growing EV segment as well.
Thank you, Sonia. This acquisition is a brand new portion, so it's not increasing content per car or something like that. It's adding in a very smart way the ability to work together with the car makers to assemble their requirements in just-in-time, just-in-sequence basis on the car lines in their plants itself. So that's the acquisition that we have done. It brings us very close to the car makers because we are now absolutely in sync with what are they doing, what are they producing. It's not just our production, it's also production from our other companies and all that, putting it together for the car makers. So it's a very new field, but something which we've always wanted to be, and that is to be a 0.5 tier supplier to car maker.
Okay, I do want some numbers. So Kunal Malani, I guess, would be helpful on that front as well. Kunal, thanks for joining in. You have said in your presentation that you will take debt on as well as internal accruals to fund this deal. Now, currently, SAMIL is sitting on net debt of around 8,440 crores. How much additional debt would you take on board? And what would you be comfortable in terms of a debt-equity ratio post the acquisition?
Yeah, so I think the net debt to EBITDA ratio is what we follow, which is 1.8x basis December results that we announced. Even if we consider the whole 540 million as debt, just theoretically, we would be slightly above 2x. And considering an improvement trajectory going forward, at the point of closing, I still expect that the whole thing will still mean a debt EBITDA of less than 2x, assuming even the full being on debt basis. Reality,
so we are going with the So we are going with the assumption that you'll fund it entirely through debt.
No, it will have an internal accrual. I'm just giving you the worst case situation, and hence in reality, I think we will lie somewhere between 1.8x and 2x as net debt to EBITDA at the point of closing, which is 5 to 7 months from now.
Okay, all right. Hi, Mr. Sehgal and Kunal. Thanks so much for joining in. Well, I think it would throw up also a cross-selling opportunity, right? And you all would be having some synergy benefits. Could you quantify any of this?
Definitely. This is, we are buying this company from a company which is specializing more in the interior portion of the car. But as you know, we manufacture for exterior also. So there are a lot of other modules that come in, like front-end module, rear-end module. This company at the moment is only in cockpits. That's the panel which is in front of you when you're driving. So that is there, but also we are in trucks. This company is only in the cars, but we are also in trucks, we're in two-wheelers. So across the board, we can bring this in. The interesting thing is that the entire team is going to come in with us over here, and sky is the limit how they can grow. So it's a new vertical that is emerging from an existing vertical of Motherson, that's a polymer group. But it'll be more on the logistics and also interior and exterior parts.
All right, Kunal, I wanted a little more details on how this would help you in terms of an operational performance. So the margins of the acquired business is around 11.5%, and SAMIL's own margins have been in a range of around 6.5 to 8.3%. Can we assume that the blended margins post the acquisition coming through will move up? And if yes, what on an average is the band that you're looking at?
Look, as you know, we do not really talk about percentage margin. But yes, needless to say, when this asset comes in on a blended basis, the margin profile should look better than what the SAMIL one is right now, just because this is at a margin higher than where SAMIL is today. Having said so, with all the synergies that Mr. Sehgal was just mentioning, we do expect sizable amount of growth to get embedded into the asset, and hence going forward to see an improving margin trajectory as well.
Just thinking out loud, Kunal or Mr. Sehgal, you could comment on this. What led Faurecia to sell SAS? They acquired this in 2019 itself. It's a very good acquisition from the shareholders' perspective for y'all. But what led the seller to sell this particular business? Because they acquired, I think it was a JV between Continental and Faurecia, and they just acquired it 3 years ago or so.
That question is best answered by them. We are in no position to answer.
No, because it's looking so good for your shareholders. I was just wondering what was the counterpart thinking. But anyways, it's great from your shareholder perspective as well. In terms of in terms of
good things happen to us.
Mr. Sehgal, I think this whole electric vehicle space, right? It's something that you're keenly focusing on as well, and the intention looks like you want to sort of raise your revenue proportion there. Currently, about 6% of your revenues comes from EV sales for the consolidated SAMIL entity, as part of, I noticed as part of your presentation. Given that SAS has a big presence in EVs, how much do you think you can eventually take the contribution up by?
I think Kunal would be better poised to answer this. But
Kunal, go ahead.
50%. But go ahead, Kunal.
So this asset carries 50% of its revenues being EVs. So in effect, we would be looking at closer to 8-9% at an aggregate level now. Having said so, our own portfolio, if you look at from an order book perspective, nearly 37% of our order book is also EVs. So going forward, the share of EVs seems to be increasing quite substantially at an aggregate level for us as well.
Okay, and one final question, Mr. Sehgal, any more acquisitions on the anvil this year, in this calendar year?
We'll be getting back to you tomorrow.
I'll get back to you before you get back to me, you know that.
Yeah, but I think, Sonia, what's important for you to understand is the last 2.5 years, because of COVID, we have been doing a lot of due diligences and all that, and there's a lot of pain in the system. So definitely, before March is over, you will hear of some more acquisitions. That's the best guidance.
Okay, all the best. Mr. Sehgal and Kunal, thank you for stopping by and speaking to CNBC-TV18. That is Samvardhan Madison talking about the recent acquisition of SAS. They're saying that at an absolute level, the debt to EBITDA maximum will go up to about 1.8 to 2 times post the acquisition, and they're comfortable with that. Let's take a quick break on that note. On the other side of the break, we will have Mitesh Thakkar join in for a quick technical check. Stay with us.
Welcome back. Well, the markets have seen a good pullback in the last few minutes, and now we're up close to 50 points, on the verge of moving to around that 18,000 odd mark. So it's a good start, one would have to say. The Nifty Bank as well is up 130 points. Mitesh Thakkar is back with us. Mitesh, what do you make of the first hour action, and what any more trading picks you have for us?
So, as I said, I think we might head towards the upper end of the range, which means that a reattempt towards 18,150 levels. That seems to be the movement which is playing out. I have, in fact, 2 buy calls right now. Coal India is something which is getting into an upward kind of a zone with all the short-term indicators now turning up. So that's a buy. Keep a stop just below levels of 215 and look for a target of around 226, 227 on the upside. The other one which I like is Escorts. Good candlestick pattern here. The indicator setup is positive. So that's a buy with the stop below 2095 and a target of around 2200 on the upside.
Okay, thanks a lot, Mitesh, for that. Well, let's go across to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking this morning?
Sonia, thank you. I'm looking at the energy markets where we have seen declines continuing. So after falling for a third straight week and a decline of nearly 5% in the previous week, we are up by nearly 0.5% right now, but still just about holding around that $83 per barrel mark. You are looking at pressure coming into the markets because one, there has been an increase in inventories, and then hotter than expected US data has fanned concerns of a higher rate hike. This is what the markets are factoring in right now. It also is about the US crude inventories, which have risen to 842 million barrels now, which is the highest since October 2022. Also, US is going to release from its inventories 26 million barrels into the open market. This also will increase supplies and lower the prices. The only reason that you still have $80 holding into the international markets is because IEA and OPEC both have raised forecasts for 2023 demand growth, with most of this demand really coming in from Asia and within that from China as well. So all eyes onto that one. Markets also are looking at higher supplies coming in from Kazakhstan, which has supplied nearly 1 lakh tons of oil via the Russian Druzhba pipeline to Germany. So the supplies really have not stopped, and the Russian supplies have continued to come into the Indian markets as well. We have seen strong imports in the month of December, and January actually had hit a record 1.4 million barrels per day. Not just crude oil prices, but the petroleum products have continued to decline. You have heating oil prices trading at a 1-year lows. The US natural gas prices trading at a 28-month lows. Prices still declined 10% in the previous week, and we have seen mild weather, higher than expected inventories. All of that continue to weigh onto the space. When you look at inventories itself, they stand at 2.2 trillion cubic feet right now. And when you look at the inventories, they are much higher than last year and higher than the 5-year average as well, putting pressure on prices. So when you look at the report card really on what we have seen in sense of prices on a week-on-week and month-on-month basis, it all has gone negative. So whether it's Brent and Urals, of course, is important to watch now because this is exactly what India is importing. We are looking at Urals prices trading at $55 a barrel with nearly 6% of a decline on a week and month basis. So all products, even coal prices trading in negative on a week and month basis.
Okay, thanks a lot, Manisha, for that. Let's slip into a quick break. On the other side of the break, Gautam Dugar of Motilal Oswal Financial Services will be joining in. They have a detailed report on how Q3 earnings have shaped up, the hits and misses for the season, and what to watch out for. More on that coming up.
Welcome back. We are zooming out of markets and zooming into earnings. The earnings season has ended and Motilal Oswal has put out a comprehensive review of the 222 companies they cover. And their one sentence heading is that corporate profitability moderated in the quarter gone by, in the earnings quarter gone by, dragged down largely by metals and oil and gas. That is basically global-facing commodities. Consumer also has been a disappointment, but what's worked in favor of the Nifty and Motilal Oswal universe have been banking and auto. To give us a more detailed analysis of the quarter gone by and what do you buy in the quarters to come, Gautam Dugar, Head of Research, Institutional Equities at Motilal Oswal Financial Services, joins us. Gautam, good morning and thank you very much. It's always educational reading your end of the quarter report. But the message is not very encouraging. Corporate earnings moderated. Your number of downgrades were more than the number of upgrades.
Yeah, hi Lata, good morning. Yes, the strength in the earnings that we had seen throughout 2021, 2022, some part of that has started dissipating beginning of FY23. And it is not reflected in the Nifty numbers because Nifty sometimes tend to hide a lot of things. So even in this quarter, if you see Nifty's performance, you have seen a 12% earnings growth in Nifty. Expectation was 14%, so nothing wrong. It's only in the broader market, the pain is far higher. Now, when I look at my coverage universe, for Motilal Oswal coverage of 222 companies, the earnings were flat. We were expecting about an 8% growth. You can dissect this earning whichever way you want. If you are bullish, you can say X of commodities, the earnings growth is 30%, which is bang in line. If you are bearish, you can say X of financials, there is no growth in Nifty, there's 0% growth. For our coverage universe, actually, there was a 14% earnings decline X of financials. We were expecting a flattish number. And most importantly, if I look at our own coverage universe by removing Nifty companies, there was a 18% earnings decline. we were expecting about 3% earnings decline. So Nifty gives you a very different picture than the broader markets, and that is where large part of the pain resides. Plus, the growth that you're seeing in Nifty, as I mentioned, is very narrow. This time around, auto has contributed significantly, and it is happening after a long, long time. So auto has gone through 5 years of a down cycle, both in volumes and profitability. And this is the first quarter after last many, many quarters that auto has actually seen a material earnings upgrade. And the breadth of the earnings upgrade in auto sector is also quite high. And of course, financials continues to remain very resilient. You are obviously going to see a financials profit in Nifty this year alone crossing 2 lakh crores. We are at 2.1 trillion. And as I've said before in the past, between FY18 to FY23, the financials profits are up 5x from 45,000 crores to 2,10,000 crores. But that's the only prettier part of the picture. Most of the other sectors have disappointed. Like auto has been a positive revelation. Consumption has been a bit of a concern because there is a broad-based consumption slowdown, which is reflected in the numbers, whether you look at staples, discretionary, durables, and of course, two-wheelers. So it's a very mixed picture, slightly concerning, given that the strength of the earnings which was there in 21 and 22, some part of that has dissipated.
Okay, fair point. But, more than analysing the quarter gone by, I'm interested in those pages of your report which are speaking about the quarters to come, because that's where we want to know where we can place our bets. Now, let me first come to the Nifty earnings forecast itself. You're expecting the Nifty EPS next year to be at 993 compared to 812. That is the downgraded EPS, Nifty EPS for the current year. That's a good 22% jump. Do you think in the quarters to come, there will be some downward revision to this?
Yes, Lata, there are many angles to that number. First of all, this year in FY23 for Nifty, the 12% earnings growth that you're seeing is purely led by financials and auto. On a full year basis also, Nifty earnings are flat without financials. One of the important changes in FY23 versus FY22, when you look at Nifty earnings, is that commodities earnings have completely collapsed. FY22, when you looked at the picture, Nifty earnings were up 35%, right? Without commodities, the Nifty earnings were up 20%. Okay. Right? This year, Nifty earnings without commodities are already up 30%. So commodities, which were a big uplifter last year, have become a big drag this year. And next year, that is FY24, you are seeing some, profits coming back. So for example, in metals, if you see the profits were 75,000 crores in FY22 in Nifty, the three companies, because 40,000 crores came from Tata Steel last year. This year in FY23, the profits in metal space is down to 25,000 crores. So that's almost 1/3. And next year, the expectations are it will be somewhere about 50,000 crores. So if you look at it on a YOY basis, the picture looks slightly more dramatic. But if you look at it between FY22 to FY24, metals earnings will still be down. And because both metals and oil and gas are such a large part of the profit pool in Nifty, while their index weight is about 12-13%, their profit pool weight is about 20-25%. So whenever things change drastically over there, both on upside and downside, it has an exaggerated impact on earnings for Nifty. So next year, if you look at pure Nifty earnings without commodities, the growth is somewhere about 14-15% and not 22%. So that is the extra element of growth that you are seeing because commodity profits are making a comeback again in FY24.
Yeah, no, I take your point because metals, as you, your breakup of that 22%, metals are contributing 125%, clearly because this year they are deeply negative, minus 68% in terms of profit fall. And therefore, there is the low base that's also, helping. But you're expecting continued very good performance by automobiles, a 226% rise in profit current year, on top of it, an 83% rise in earnings next year. So automobiles remain one of your strong bets. That's where those are the stocks you would chase?
Yes, but let me normalize the numbers because this 226% again is a bit of an outlier. So what happened? In FY18, the Nifty auto universe made a profit of 30,000 crores. It's exactly the year when banking sector made a profit of 45,000 crores. Now, between FY18 and FY23, while banking sector's profit moved from 45,000 to 210,000 crores. Auto sector's profit in Nifty has come down from 30 to somewhere about 20,000 crores, right? So auto has gone through 5 years of profit recession or down cycle, whatever you want to call it. Some of that is now coming back because your volumes are improving, especially in PV and CV. Supply situation has eased, especially on semiconductor side, and commodity prices have come off. So if you look at this quarter's performance also, auto was the only sector where you've seen a very substantial and material gross margin expansion of about 360 basis point YOY. Most of the other sectors had a decline or a very minuscule margin expansion. And as I said, auto earnings have seen a 25% upgrade for Nifty. Within the Nifty, auto earnings have been upgraded by 25%. Now, this has happened first time in last many, many years, except 1 or 2 quarters of the post-COVID when things started opening up. But they came on a very low base. Here you've seen a 25% upgrade. 5 out of 6 Nifty auto companies have seen an upgrade. And going forward, our expectation is that as volumes stabilize, the impact of operating leverage will also come into play. So therefore, we are expecting that auto cycle, which has seen a first year of a decent earnings, will continue because you're coming on a back of a 4 to 5 years of a no growth or rather degrowth of 5 years.
Fair enough. Fair enough. So that explains why auto is doing well. Well, speaking about autos, I have to ask you about Motherson. It was already in your buy list, and today they've announced a fairly decent takeover, which is going to impact about 10% of their, the size of the company. Does that make it a stronger buy?
So, Lata, Motherson is already part of our top 10 2023 ideas.
Yes.
And numbers were good. We had upgraded earnings after the quarter. And this acquisition obviously is making sense because it is an EPS accretive acquisition for them and adds to their product market as well as customer diversification. They've been very aggressive over the last 10, 15 years in terms of adding new avenues of growth through inorganic route. So this is a step in that direction. And it just we just reiterated our strong positive view on Motherson, which incidentally is a part of our top 10 2023 idea.
Oh, yes, it is. Let me come to mid-caps because we don't have that much time and that's a large part. Mid-caps disappointed. Will FY24 be better?
It will be better, obviously, because of a very low base. But again, in mid-caps, there's nothing called a sector. It's mostly bottom-up and company to company, depending on which sector you talk about. So you will see some improvement there because, see, consumption-oriented sectors, both staple and discretionary, as I mentioned, have seen a massive slowdown in the last 3-4 quarters. There are companies which have reported a top-line decline on a YOY basis, volume decline, obviously. Companies which are very strong brands in their respective domain with great franchises, they've been reporting 7-8 quarters of a sub 5% top-line growth now. This being an election year, there are 9 state elections, which then culminates into the big one in 2024. I think government will find ways to put money in the hands of people. There will be election spending. Hopefully, that will trickle down, and it will have some sort of an impact on consumer spending reviving, which will, with a period of lag of couple of quarters, should reflect in consumption numbers. So mid caps belonging to those segments, something like a Page or a Trend or I'm just taking few names, footwear companies, which have massive slowdown. Some of them can obviously come back into reckoning if there is a improvement in consumer sentiment and better consumer spending forward. Then obviously financials, whether it's a mid cap or a small cap or a large cap, have been on a tear. So they will continue to. That's our expectation. And then
but within financials, Gautam, I'm sorry to interrupt. I'm trying to get the most from you. Within financials, do you think the best of PSU rally is over? I believe by your analysis, the PSU profit growth was 54%, or rather is 54% in the current year. It starts tapering because all the credit cost advantages have been juiced out. So that won't form a part of your buy list?
In fact, it is part of our single largest allocation in our model portfolio.
Okay.
We have about 7% allocation to PSU Bank versus a benchmark allocation of a 2.5%. And our conviction in some of the chosen stocks there, SBI and Bank of Baroda, remains very high. To your point of this growth not being replicable, it's quite obvious because the base will start working against them now. You've seen a very strong performance in FY22 and FY23. So to that extent, there will be a normalization of a base. But having said that, private banks started getting the benefit of an asset quality at least 1.5 years before PSU banks. So for private banks, the credit cost started declining substantially in FY20,
Earlier.
which happened for PSU banks only in FY22. So to that extent, PSU banks, as far as specific numbers are concerned on credit cost and P&L numbers, they have some more rooms, a few more quarters before their numbers start tapering completely. So, and of course, while valuations have re-rated to an extent, but so has their ROEs, right? And so far from the commentaries of those banks, it seems that this credit cycle on the credit growth fund is here to stay for at least a couple of more years.
Okay. Well, I'm sorry we are out of time, but the big message is that if corporate earnings moderated somewhat in Q3, the prospects for FY24 still seem very good. 22% earnings growth only for Nifty EPS, led by automobiles, led by metals as well after a very bad base, as well by financials. And I wish we'll invite you yet again to discuss all your mid-cap top buys. We ran them as you were speaking. Dalmia Bharat, API Apollo Tubes, Jubilant Food, Poonawalla FinCorp, Metro Brands, Angel One, Lemon Tree. Another special session with you to discuss your mid-caps. Thank you very much, Gautam, for joining us. Have to wrap up on Bazaar. Chartbusters up next.